Let me ask you something. If I told you I had two investments to show you, one that made 24% last year and one that made 7%, which one would you want to hear more about? Most people would lean forward for the 24%. And that instinct is one of the biggest threats to your retirement security. Today, we're going to talk about why the boring investment, the one with the modest, unexciting, nothing to brag about returns, is often the one that actually wins in retirement. And more importantly, why that's not a bug. That's the entire point. Stay with me, because by the end of this video, you're going to see retirement math in a completely different way. Here's something nobody talks about at dinner parties. The stock market is exciting. It gives you years where you feel like a genius, up 20%, up 28%, and you're watching your account grow and thinking, this is incredible. And then it gives you years that take your breath away for all the wrong reasons. Down 25%, down 38%, down 49%, like we saw in the 2008 financial crisis. Now, if you're 35 years old and that happens, you have time. You keep contributing. The market recovers, and eventually you come out ahead. That's how long-term investing is supposed to work. But here's what changes when you retire. When you retire, you stop adding money to your account, and you start taking money out every single month. And that changes everything. When the market drops 30% in your first 2 years of retirement, you're selling shares at the worst possible time to fund your living expenses. And those shares, they're gone. They can't recover because you already spent them. This is called sequence of returns risk, and it's the single biggest mathematical threat to your retirement income. It's not about what the market averages over 20 years. It's about what it does in your first few years of withdrawals. And that's exactly where boring starts to look very, very attractive. So let's talk about what a fixed indexed annuity, or FIA, actually does. And I want to be completely transparent with you here, because I think too many people either oversell these or dismiss them without understanding them. A fixed indexed annuity does not put your money directly in the stock market. Instead, it links your potential growth to a market index, like the S&P 500, while protecting you from market losses. There are a few ways insurance companies manage this. You might hear terms like participation rate, cap rate, or spread. Here's the plain English version. A participation rate means you get a percentage of the index's gain. If the participation rate is 50% and the index goes up 20%, you'd be credited 10%. A cap rate means there's a ceiling on how much you can earn in a given year. If the cap is 10% and the market goes up 22%, you get 10%. A spread is a different structure. The insurance company takes a fixed percentage off the top, and you get the rest. Now, different products use different strategies, and the specifics matter, which is why individualized guidance is so important. But here's the part I really want you to hold on to. When the market goes up, you participate up to your cap or participation rate. When the market goes down, you get zero. Not negative, zero. Your principal is protected. Think of it this way. The market zigs and zags, up, way down, recover. An FIA moves like a staircase. Up a little, flat. Up a little more, flat. Never backward. That staircase, that's what retirement income security looks like. Now, let's look at why that staircase beats the zigzag more often than people expect. And it comes down to one simple, powerful concept. Zero is a hero. Here's a math most people have never seen illustrated clearly. If you lose 25% of your money, you don't need a 25% gain to get back to where you started. You need a 33% gain. Lose 30%, you need a 43% gain just to break even. Lose 50%, you need a full 100% gain to recover. Losses are mathematically more destructive than equivalent gains are helpful. That's not an opinion, that's arithmetic. Now, let's bring this to life. Imagine two people. We'll call them Carol and Linda. Both retire at 65 with $300,000. Carol keeps her money in a market-based portfolio. Over the next 10 years, she has some great years and some terrible ones, including one year where she loses 32%. Linda puts her $300,000 into a fixed index annuity. Her best years are capped, but she never loses a dime of what she's accumulated. At the end of 10 years, even though Carol had higher highs, Linda often ends up with more money. Not because her good years were better, but because she never had to dig herself out of a hole. And here's the part that really matters for retirees specifically. Linda was taking income from her account the entire time. Carol was selling shares during the downturns. Linda was not. That's the difference between a zigzag and a staircase. And in retirement, the staircase wins. So we've talked about the math, but I want to take a moment to talk about something just as important, because what this kind of predictability actually buys you in your life. Because the number in your account isn't the whole story. First, it buys you peace of mind. When you have protected, predictable growth, you stop doing something that quietly destroys so many retirements. Checking your account balance every morning and letting that number determine your mood, your emotional state, whether you feel okay about your life. Retirees with guaranteed protected income sleep better. That's not a small thing. Second, it buys you the freedom to actually spend your money. Research consistently shows that retirees without guaranteed income tend to underspend, not because they don't have enough, but because they're afraid of running out. They hoard instead of enjoy. When you know your income is protected, when you can look at your statement and see that number is never going backward, you give yourself permission to take the trip, help the grandkids, live the retirement you worked for. Third, it protects you from the most dangerous investor in the room. And that investor is you in a panic. When the market drops 30% and the news is terrifying, even the most disciplined investors feel the urge to sell, to get out, to stop the bleeding. And selling at the bottom locks in losses permanently. With an FIA, there's nothing to panic about. The floor is built in. And fourth, for those of you watching who are also thinking about Social Security and Medicare, predictable, stable income makes planning dramatically easier. When I'm working with clients on reducing their provisional income to lower their Social Security taxes, or on managing their modified adjusted gross income to avoid IRMA surcharges on Medicare, having a known, consistent income picture makes all of that planning far more precise. You're not guessing, you're planning. Now, I want to be straight with you, because I believe the most valuable thing I can offer you is an honest education, not the sales pitch. A fixed index annuity is not the right fit for everyone. It is a strong fit if you're within about 5 to 10 years of retirement or already there. If you have accumulated money you cannot afford to lose, money that needs to be working for your income, not gambling on your behalf. If you want income you can count on, more than returns you can brag about at the golf course. It's probably not the right fit if you're decades away from retirement and have plenty of time to ride out market cycles. Or if you have a substantial guaranteed income from other sources and you generally don't need this layer of protection. I say this because I want you to trust what I tell you. And the only way to build that trust is to be honest about when something is right for you and when it isn't. So let's bring this full circle. You started this video thinking that 24% sounds a lot better than 7%. And in a vacuum, sure it does. But retirement is not a vacuum. Retirement is a sequence of real years with real withdrawals, real market swings, and a very real risk that a few bad years early on can permanently alter your financial future. Boring returns that never go backward will almost always outperform exciting returns that fall into an abyss, especially when you're living off that money every single month. The staircase beats the zigzag. Zero is a hero. And boring in the context of retirement income might just be the most exciting thing you can ever do for your financial future. If you'd like to learn more, take a look at the free booklet called Retire Smart. It's linked on the page in the description box. And if this was helpful, please give it a thumbs up, subscribe to the channel, and share it with someone who's getting close to retirement. This is Retirement Security Simplified, where we specialize in turning confusion into confidence, one conversation at a time.